Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is August the 18th, 2023. It is now 2:42 p.m. Central Time. We still have just over an hour left in the trading day for our bonds and mortgage-backed securities, and really just finishing up a really tough week. We've had a tough week. We're going to take a look at the charts and see what's going on, see what is under us as far as support and what we expect to happen in the near future. But then I'm going to go way further back here. We're going to take a look at the charts briefly, and we're going to see what it looked like before COVID. Before COVID, and as we rolled into COVID, what happened at that time, and then when things really changed. So it's good for us to have some perspective and know where we were based on the charts that we look at each day, because it's easy to not really have that perspective. We're going to take a look at that here in a minute. And if you did not watch the video that I put out yesterday talking about why a 10-year treasury bond matters to home loan interest rates, make sure that you do go back. I'm going to put a link to that video down below, but that is one of the most well received. And I've had more comments about that video probably than any other video I've ever done, because it is something that people don't understand why it is the case. So again, it's about 10 minutes, but I think it's going to be well worth your time. Make sure that you like, subscribe, share, hit the notification bell underneath here so that you always get updated of those things. So let's take a look at some charts here and go back in time. First of all, here we are for the day. We're, bounced off the Fibonacci level here, which is 97.563 at this point. Again, using it as a floor of support under us, which is good. You can see we've had a rough go, right? What is this, about 7-8 days before we hit this Fibonacci level, bounced off of it, and now it seems to be acting as a floor of support under us as we finish off the week. Now, the leash effect is something that we clearly see going on here, okay? Normally, when you move this far away from your moving averages, okay, here's our moving averages, our 200, our 100, or 50, or 25. We're usually talking about these moving averages acting as ceilings of resistance and floors of support underneath us. But because we're so far away from them at this point, it really tends to cause a leash effect, which is where they get pulled back and we head back into this range. This is too aggressive of a move for the markets in most cases. You can see it right here. Moved away, boom, bounced back into the moving averages. Moved away, bounced back into the moving averages. Moved away, and hopefully we're going to bounce back into the moving averages here next week. All right, so let's take a quick look at where we were back before COVID. Let's shoot back over here, hit longer time frames on our interactive chart here. Again, all this information, we always want to give a big shout out to our friends at MBS Highway, who put this stuff together for us every single day and pay close attention to giving us all kinds of insight. So let's go back. Now we are now 3 years back. What does that look like? Going to go over here. All right, we're going to go even further back. So we're going to go maximum because we want to see before we even had COVID happen. All right. So now, if you look down here, you're going to see the date. This is March of 2019. Here we go, moving along. April, May. Rates are sort of kind of getting better and better. Remember, when this goes up, that means interest rates are going down. Okay. So in 2018, we had a little bit of a rough go. I remember feeling like rates were really high because we were touching on the fives, if you can imagine that. So here we were, all of a sudden, things got better and better. Things were improving. Home loan interest rates were going down, down, down. And then what happens here? Where are we at? About right here. This is March of 2020. Does anyone raise your hand? Does anyone know what happened in March of 2020? Well, the pandemic broke out. Schools are heading, closing down, and everything is going crazy. All right. So you can see that there is a very direct flight to safety. When this shot up, it's because of the fears that hit the economy. People moved money into bonds. Okay. Things began to settle down, but over time, they kept on moving money into the bond market, and you can see that home loan interest rates got much, much better. Now, here is when it was really, really, really that best day. That day when maybe we could have done a 2.5% 30-year fix with no points. Okay, you guys remember those days? And then what do you know? Inflation rears its head. And all of a sudden, we have these big talks of inflation. And there we go. And we just start dropping and dropping and dropping. Now, here's what I'm hoping, okay? As you can see, whenever you look at these charts, this is like a bouncing ball, okay? So it kind of goes up and down and up and down and up and down. So we have a big drop all the way down to here. And if things go well, hopefully that was the floor, because you can see we had a pretty good bounce, and then it dropped down, a little bit of a bounce, and then it dropped down, and hopefully we're going to have a bounce again and begin to come back up. Now this goes to show how far of a drop was this. So if this was our peak here at 112.30 on a 5.5%, a 5.5% 30-year mortgage-backed security coupon, that's what that's called. So if you go back to this date here, October 13th, 2021, we were at 112.47. Now we are sitting here on the same coupon at 97.4. Okay, so this is a 1,500, approximately 1,500 basis point swing. We have lost 1,500 basis points on the 5.5% coupon. Now, there's a lot that goes into that, but that gives you some perspective as to how far we would have to climb to get back to a situation where we're offering interest rates in the low 3s and 2s. All right. So now let's take a look and see where we actually are on our interest rates as of today. Let's run our Brent Bruce Daily, very well qualified, 30-year fixed conventional 30-year fixed conventional home loan. We'll pull the rates here. I'm going to open this up first and give you the parameters for what we're taking a look at here. 800 FICO score, primary residence, 25% down, just an ideal client. Okay, so where are we? Well, 11 Mortgage is one of the companies that we use. And again, I want to point out that all of these mortgage companies, this is not where you can go get a home loan, guys. You cannot go call 11 Mortgage and do a home loan. These are the wholesalers that brokers do business with. Okay, so when you call a broker, when you call Rancho Capital, you're going to work with Rancho Capital, but we have access to banks that consumers don't. That's why we have lower interest rates. Okay, so we have a different situation than you're going to find at a mortgage banker. Mortgage bankers have a different situation than mortgage brokers do, and mortgage brokers have lower interest rates, almost bar none. So let's take a look and see. Go back here. 11 Mortgage is offering for me to give you a 7.49% with $450 back. Okay, so 7.49, $450 in credit. If we open this up, what does it look like if you're to pay a point or the client is to pay a point? So let's go all the way back to, we're here, right here, 99, 7.4. We got to go to 99, right about here. Okay, 1.05, and you get into 7.125. Not a huge difference in paying a point. All right, let's always go back and take a look at where we are on that 5.99 because we've been looking at that for over a year. Well, right now it's costing 4.7% to get down to that 5.99. Again, a very large swing, because if you remember, we're talking about history here. If you watch this show regularly, you know that it was not that long ago that I told you I could do a 5.875% interest rate on the Brent Bruce Daily scenario with no points. That was not something that I thought I could do. I was doing them. Okay, so that is where we were not that long ago, and how we can get back to if we have a good run. Okay, so we can see a big difference. And if you want to know why we can see that big of a difference, go back and watch the video I did yesterday on the 10-year Treasury bond and understanding that the mortgage servicing premiums change quickly when interest rates drop. There's other parts to this puzzle. So that's where we are right now, guys. Make sure that you like, subscribe, share, hit the notification bell in the bottom. And if you have any buyers, why not see what I can do for them? Let me see what kind of a rate I can put together for your buyers in California and Tennessee. Make sure that you reach out to me. Have a great weekend. I'll talk to you again next week.